Hello, hello. How are you feeling today? Today, we're going to be talking about option strategies from the trading floor. This is going to be a really interesting presentation. Before we get started, I need to make sure that you can hear me. If you can hear me, please, and if you can see my screen, I think you can see my screen. I'll tell you what, if you can see my screen, please go to the questions box or chat box, whichever of those you can see, and let me know that you can see my screen. Just give me a yes. That would help me a lot if I know that. Hey, Justin, how are you, my friend? Maria, chat is disabled. Yeah, I always forget which of those. So yeah, very good, very good. Okay. Um, Robert, hey, how are you, my friend? Alays, I hope I said that right. Uh, okay, William, hiya, 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 hiya. NTIS. NTIS. I don't know how to pronounce that, but NTIS, how are you? Yes, I can hear you and see your screen, says Marie and Benjamin. Yeah, you guys are great. So yes, the Q and A box is where we're going here with this. All right, all good news. Now, before we get started, I need to point out that options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investor services at theocc.com. Don't trade with money you're not prepared to lose. And everything we're doing here today is intended to be general information, not personal advice. I see some familiar names here, and I love when you come back for more and more and more. That makes me feel good that I'm providing value to you, which I love to do. But I see some new names here too, so allow me to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular books on option trading, um, and many articles and such. And I'm a trader. I spent many, many years of my trading career as a professional trader. And now I trade in a retail trading account, just like you. And I am the founder and president of Market Taker Mentoring, which is the global leader in option trader education. We have uh, we have trained traders in over 50 countries, traders just like you. And I'm a trading industry collaborator. I've worked with every major options broker, all the good ones anyway, like Firstrade here, as well as many of the options exchanges in the world, maybe all of them in some capacity at one point or another. So I've been around the block in this industry. And I'm a family man, married to my wife, Kathleen, who many of you know, and my two adult children. And I do some things for fun outside of trading. Trading's fun too. And training uh, folks to trade better is fun for me. But I also try and stay in shape. I'm a runner. I am also a foodie, which sometimes counteracts that running. A traveler, me and my family and colleagues have been literally all over the world vacationing and training traders. We've trained traders in many other countries, trained traders in Asia. And I'm a music person as well, both from the listening standpoint and playing it. Now, I want you to get as much value out of my presentations as possible. So, in addition to what we talk about today, what I invite you to do is go to markettaker.com, and you can see that right there. Market is in stock market, taker is in take what is rightfully yours, markettaker.com, and just simply go right there to join free in the top right. And you can join our community and get some complimentary classes and ebooks and other complimentary online trainings just like this one. And as the name implies, it's all free. So here's what we're going to talk about today. We're going to talk about the makers and the takers. We're going to talk about middling markets, straddles, time spread volatility play, and the biggest and best secret strategy from the trading floor. Ooh, so be sure to stay until the end for that one. Well, let's talk about the makers and the takers. So a good part of my professional trading career was spent as what is called a market maker. And that is the person who makes the market being a bid and an ask. And there is a market, a bid and an ask for every option out there. And there's hundreds of thousands of them. I didn't make markets in hundreds of thousands of options, but I did make markets on about 20 different stocks and all the options associated with that stock. So certainly thousands, maybe tens of thousands. And that's what market makers are. Now, market takers, that's everybody else. That's who I am now. That's who you are. We are the ones who take the market. If the offer is $1, we pay $1. If the bid is 55 cents, we sell it 55 cents. Now, today, I'm going to show you some tips and tricks to do better than that when we talk about middling markets. Tips and tricks that come from the market maker side, which I used to do. So I'm kind of giving you the inside scoop on how to do this. But let's kind of explore the differences a little bit more so you have a deep understanding of the difference between market makers and market takers. So being a market maker is a real niche strategy. There of all the traders that there are in the world, so like, thousands, not even thousands, hundreds of thousands, maybe even millions, most people don't trade like market makers. Very, very niche of a strategy. And what they do is they provide liquidity. Because a lot of people don't think about this, but when you see a bid and an ask on your Firstrade platform, a lot of people don't think about where those come from. Some people think Firstrade puts them all up there, and maybe they're different on some other brokerage firm. Well, no. All those bids and offers, there's someone somewhere in the world who wants to buy at that bid. And there's somewhere in the world who wants to sell at that offer. And a lot of times it's the same person, and that person is the market maker. Now, in order to do that, market makers do a lot of trading. You might do tens of trades a day. You might do thousands and thousands of contracts a day. So market makers really need to be well capitalized. These days, there's not some person, some individual standing on the trading floor making markets. These days, it's a firm. Now they hire an individual to oversee and actually execute the trades, but they have very, very, very deep pockets. They're very, very well capitalized. And that gives them the advantage of being able to seek really very small profits because they do it on such a large volume. What they do is they try to make money on the bid-ask spread. And if you look at some like ETFs, like SPY, which is one of the most liquid options that you can trade, most of those options are a penny or 2 pennies wide. So that's really what market makers are trying to make. They're trying to make pennies, but just over and over and over and over and over again. Because, of course, 1 penny of option premium is $1 of money. If you trade 1 million contracts throughout the course of a year, well, you did pretty good, right? So what are market takers? Like I said, they're everybody else. The people who take liquidity instead of make liquidity. And for market takers, we're all over the place. Capitalization varies. There are some market takers, even ones that I train personally at Market Taker Mentoring, who have, $3,000 accounts. And there are some who have $10 million accounts. It's kind of all over the board. And to that point, so is skill. Some are brand new traders, and there might be some brand new traders here. Some have some experience, some have a lot of experience. And there might be some of you here who have a lot of experience, but you just know that a lifetime of learning is very beneficial in anything, including and especially as a trader. The more you learn, the more you earn. And so I've been in trading for 30 years and I am a teacher of trading, but I will always, always consider myself a student of trading. And I hope you do too. So market takers, they're not looking for very small profits. They're not trying to make pennies. For what they're doing, what we're doing, is we seek larger profits on smaller volume. We are typically position traders where we trade direction or for income or volatility. So let's talk about trading the bid-ask spread. I kind of want to show you exactly what it is that I'm talking about here. So say right here, we're looking at, this stock here. And we're looking at, it happens to be Walmart. We're looking at the 85 strike calls. So it's 190 bid at 192. Okay. Now that's a reasonably tight market. There, if I wanted to buy, I would buy at 192. If I wanted to sell, I would sell at 190. And there's probably not a whole lot of room to trade in the middle there. We're going to talk more about middling the markets in just a second. But you probably wonder, like, where do those markets come from? Now, I just told you a minute ago, they come from market makers, liquidity providers. But why are they 190 bid at 192? Why aren't they $2 bid at 202 or 205 or 250? Why aren't they 3-cent bid at 10 cents or 50 cents or $1? Where does that come from? Well, there's some patterns that you might recognize when you look at any option chain. For calls, the lower the strike, the higher the value, and the higher strike, the lower the value. And that's just the opposite for puts, which is intuitive because if I have the right to buy at 80, or I have the right to buy at 85, clearly the right to buy at 80 is more valuable than the right to buy at 85. I get to buy it $5 cheaper, so it's going to be worth more. So there's sort of a glue that holds all this together, and that's called the options pricing model. What market makers do is they run what is called a theoretical value. And the theoretical value is basically smack dab in the middle here of the bid and the offer. The market makers for these 85 calls might value these calls at $1.91. And just like running any other business, if I can buy under value or sell over value, now I've got a business. And That is exactly what market makers do. For every option they trade, they run a theoretical value and they buy below it and sell above it, and they make these theoretical profits. Now, look, if a market maker only made one trade in his or her lifetime, well, that theoretical profit doesn't necessarily mean anything. But if I'm constantly all day long buying below theoretical, selling above theoretical, selling above, buying below, selling above, and I'm just going back and forth, buying and selling, all that theoretical profit ends up becoming real profit. Now, there's a little bit more to the story here, and let's talk about that. Let's talk about after the option trade. So when a market maker makes a trade, the market makers trade delta neutral. Now, those of you who have been watching my online presentations here with Firstrade or the many other ones I do at markettaker.com, you've heard me talk about the Greeks. Well, the Greeks is very important. Delta is one of them. Delta is just directional sensitivity. So when a market maker makes an option trade and therefore gets the delta associated with that option, the directional exposure associated with that option, that's the first thing that the market maker wants to do. Hedge off the delta to spread off the risk. So the first thing the market maker does is if they buy calls, they sell short stock. If they sell calls, they buy stock. If they buy puts, they buy stock. If they sell puts, they sell stock. But they do it on a very specific ratio, which is called the delta. Now, once they hedge the delta, they also want to spread off the other risk. Just like I said, if they just make one trade in their lifetime, well, they're going to have time decay working against them or for them, gamma working for them or against them, respectively, vega. So they have to buy and sell and buy and sell and buy and sell and lock in these theoretical pennies and try and keep all their Greeks small by spreading off the risk. So let's say maybe somebody here in this room is a bigger trader, has a pretty well-capitalized account, and you go in and you buy 100 of these Walmart 85 strike calls at $1.92. Okay. Well, if you're buying 100, who are you buying them from? A market maker. There's a market maker who, again, is making that market, is saying, here's my bid, here's my offer, what do you want to do? So you buy 100, the market maker sells 100. Now, you probably buy 100 because you're a position trader. You think in this very hypothetical example that the stock is going to go up. Well, the market maker doesn't necessarily think it's going to go down. In fact, they don't think that at all. So what they do is the market maker buys shares of stock to get delta neutral to eliminate all the directional risk. Let's say each of these calls has a 52 delta. So a 52 delta means that the calls move 52% in step with stock. If I buy 100 shares of stock and the stock goes up $1, I make $1. If I buy one call that represents 100 shares that has a 52 delta and the stock goes up by $1, I make 52 cents. So if you think about it, it's kind of like owning 52 shares of the stock. So if I sell short 100 of these calls or 100 of these positions that act like 52 shares, then me as the market maker in this hypothetical example, I would need to buy 5,200 shares in order to hedge, right? Because 1 would be 52 shares, 10 would be 520 shares, 100 would be 5,200 shares. And if I do that, then if the stock goes up or down $1, I don't make or lose anything, because whatever I make on the calls, I lose on the stock, or whatever I lose on the calls, I make on the stock. Does that make sense? Hit that questions box. Give me a big old yes if that makes sense. Hit that questions box. Give me a big old yes if that makes sense. Thank you, Lewis. Thank you, Justin. Thank you, William. Thank you, Maria. And Julena. And Marie. And Benjamin and Sherry. Thank you, thank you, thank you. Okay, so let's talk now about the parties of the trade here. Let's break this down. In this trade, the market maker is short 100 calls and long 5,200 shares of stock. The market maker is delta neutral, which is just another way of saying directionally indifferent. Doesn't care if it goes up or down because it's completely hedged. The market taker, the person here in this room who bought 100 of those calls, is long the calls and is therefore bullish because it has a positive delta. So it's actually possible for both of these traders to win. I'm starting a podcast and I recorded a couple episodes and I talked with a friend of mine from the OCC, as a matter of fact, and we were talking about options being, our options a zero-sum game, meaning if one person wins, the other person loses. And the fact is, because market makers hedge and add stock to the equation, both can win, both can lose, or one can win and the other can lose, or vice versa. And we're going to talk more on how exactly that might happen with a position like the market maker has in just a bit. So what we're really doing here as a market taker is we're fighting for what is called edge. Remember, market makers have this theoretical edge. They have a value and they buy below it or sell above it, making theoretical profits, locking in theoretical edge, and they buy and sell and buy and sell and buy and sell. Now, for us market takers, that's not edge, it's negative edge. Another word for that is slippage, because we always have to buy arguably over what it's worth, or at least what the market makers agree that it's worth, or sell below what the market makers agree that it's worth. And, you know, sometimes if it's not SPY or Apple or some of these very liquid names, sometimes the markets are kind of wide, and sometimes that slippage or that negative edge can actually be pretty big. So it's important for all traders to develop a skill, the skill of middling markets. Middling markets means we trade between the bid and the ask. Now, when I say middling markets, like middle means like right in the middle, right? Well, we're seldom going to trade right in the middle. We're usually going to buy a little closer to the ask or sell a little closer to the bid, but as close to the middle as possible. And there are some advantages to this. Well, it's less slippage. It's less negative edge because we can get a better fill price. But the other part of that is there's no guarantee that if we put in a bid below the offer that we're going to get filled. And sometimes the market can move. Could be offered at $1 and I put in a 99-cent bid. And, you know, if it's a call, the stock goes up. So the call goes up by the amount of its delta. And I just missed my opportunity to buy at $1 because now it's at $1.01 or 02 or 03 or 04 or 05. So let's take a look here. Back to this example. Let's say we want to buy these 85 calls. Well, these 85 calls those are actually pretty tight. Okay. They're 190 bid at 192. The middle is 191. It's a penny above the bid, a penny below the offer. And chances are, if we put in a $1.91 bid, we're probably not going to get it. There's not a lot of room to middle it. And why wouldn't we get it? We wouldn't get filled at $1.91 because that's what the market maker thinks it's worth. Now, there's a couple of things there. One is sometimes people say, oh, Dan, I put it in the middle all the time and I get filled, at least half the time. Well, what probably happens is you put in that $1.91 bid and the stock ticks down a couple of pennies, and that, if the stock ticks down 2 penny and the call has a 52 delta, the call's theoretical value and thus the bid and the offer will each go down by a penny. And so you're not really buying in the middle anymore. The middle moved. You're actually buying on the offer. So, careful not to try and trick yourself there, right? If you actually do trade in the middle, like you put in a 191 bid and the stock doesn't move, but you get filled, then, you're kind of lucky. And that luck happens because sometimes if you're trying to buy, if the market maker is already long a lot of those, or just long a lot of options in general in Walmart, they might be willing, if they put those on for edge, they bought below the theoretical value, sometimes they might sell at the theoretical value just to, lock in just 1 penny instead of 2 and take off some of the risk. Because remember, market makers don't like risk. If they're long a lot of options, they lose time decay. Delta is a big risk for the market makers, though. So, if you're trying to buy one of these, the market maker sells you one at 192. Well, it's like the market maker's getting short 52 shares of stock. Okay. Well, it's not that big of a deal. But, you buy 10, the market maker sells you 10. Now the market maker has to buy 520 shares of stock. What happens if at the moment you make that trade, the underlying stock goes up and the market maker has to pay more for that stock? Well, that can turn a losing or a winning trade into a losing trade just like that. That's called execution risk, a delta risk. Delta is a risk to market makers. So as far as middling markets go, if we trade more out of the money options, whether it's higher strike calls or lower strike puts, it might be easier to middle those markets because those would have a smaller delta. If somebody buys 10 of these, these aren't going to have a 52 delta. They'll have, some smaller delta. Is it necessary for you to know exactly what the delta is? Not always. If you have access to that information, great. If not, it's fine. Like today, I just want you to get the concepts. So the market maker might only have to buy 300 shares of stock instead of 500 shares of stock. Well, that's less risk. If it goes against them, the stock goes up by a nickel or so. Well, they're missing a nickel on only 300 shares instead of 500 shares. So it's a little easier to middle out of the money options. At the money, and especially in the money options, market makers are a lot more careful in their middling. Now, that said, this market happens to be 12 cents wide instead of 2 cents wide. Typically, the further out of the money, the tighter the markets get. Sometimes when you see the at the monies being just a penny wide, sometimes this might be maybe the market maker's 190 bid, but or maybe the market maker's 192 offer, but maybe the market maker's only 185 bid. Maybe there's someone somewhere in the world who's a retail trader, a market taker, just like you or me, who wants to buy one at 190. And in fact, I can infer that that's probably the case here. How can I infer that? I go right over here to the column right here, B by A size. There's only one contract bid at 190, but there's 57 offered at 192. So the 57 is probably one or a collection of market makers. And that one that's bid at 190, that's probably a retail trader. And so if you need to sell these and you want to sell 10, you might only get one. So lots of stuff to think about here. So what are good candidates for middling? Well, first of all, small delta trades, bigger edge trades. So go back here for a second. Is 190 at 192. I mean, there's no room to middle that. I'd have to bid or offer at 191, and I'm probably not going to get filled. But the 87 calls, they're 113 bid at 125, 12 cents wide. What do you think the theoretical value is there? What do you think the theoretical value is of the 87 calls? It's 12 cents wide, 113 bid at 125. What do you think? Well, 12 divided by, boom, Lewis, nice. All right. I'm glad somebody's getting this and paying attention. It was definitely not an easy question to answer for most people, but great job, Lewis. Lewis says 119. How did Lewis arrive at that? Well, it's 12 cents wide. 12 divided by 2 is 6. So we can add 6 to the bid or subtract 6 from the offer, and we end up with the midpoint, which is 119. So there, if I were to middle that and I wanted to buy it, I would bid above 119 because market makers think it's worth 119. There's no advantage to them buying it or selling it at 119. But somewhere below 125, I might bid 124. I might start the bidding at 120. As long as it's below the mid and no, as long as it's above the middle and below the ask. All right, nice work. So small delta trades, because they have less execution risk, less delta risk, the market makers. They're more willing to compromise. Bigger edge trades, like I just showed you. The wider the markets, the more room in the middle there is to get. Smaller overall Greeks on the trade, which tends to mean out of the money options. Or what's another way that we can get smaller overall Greeks on a trade? Well, with spreads. Let's talk about middling spreads. Let's say instead of wanting to buy those 85 calls, I want to buy a call spread. I want to pay, instead of $1.92 by buying the 85 calls, I want to pay 40 cents by buying the 85 calls, selling the 86 calls. But I know that maybe I can buy it for even less than 40 cents. How can I buy it less than 40 cents? Well, either paying less on this one or selling it for more on this one. The delta here would be very, very small, because if this delta is 52, this delta might be something like 40 or something. So the delta is more like 12. So the market makers' execution risk or delta risk is a lot smaller. They're not as afraid to middle it because they don't have to go and buy 500 shares. They have to buy like 100 shares. So much less risk. And if these are a penny wide and these are 5 cents wide, no, if these are 2 cents wide and these are 5 cents wide, the bid-ask spread of the spread is 7 cents wide. I can buy it at 33 or sell it at 40. Or at least I should say, if I'm the market maker, I would buy it at 33, sell it at 40. Us market takers, it's the opposite. We'd have to buy it at 40 or sell it at 33. Well, you know what? That's a lot. I mean, if I'm if I'm buying that at 7 cents wide, I mean, that's like an 8% spread or something like that. I'm losing 8% just making the trade in slippage, negative edge. So if I look at the theoretical value, 40 minus 33 is 7 cents. Divided by 2 is 3.5 cents. So we add that to the bid. So that's 36.5 cents is the theoretical value. Well, now I've got a baseline. If I'm going to buy this, I'm going to have to bid more than 36.5 cents. But I want to buy it for less than 40. So I'm going to put in a bid of, usually if I bid 37 cents, it's not quite enough. They're only making half a penny of edge. I'd probably bid something like 38 cents. Even if I bid 39 cents, it's still better than 40 cents. So because the market makers have so much more edge on this, on a spread, than an individual option, because remember, the bid-ask spread it's this width plus this width, so it's always going to be wider. There tend to be, and the delta is smaller, and to be fair, the theta, gamma, and vega are also smaller. Market makers tend to be a lot more willing to concede some of their edge just to have a trade with so much less risk. All right, so let's talk about straddles. Now, this is going to be brand new for a lot of people, and it can be a little confusing. I'm going to tell you that going in. And we only have so much time here, so I have to go at a fast enough pace. So if you don't get all this immediately, well, first of all, you're normal and it's okay. You can just go back and watch the recordings of these because the good people at Firstrade always record them. So the straddle is a volatility strategy, and it's a market maker strategy. Some of us market takers trade those occasionally, but market makers look at basically every one of their trades as a straddle, because market makers think about straddles differently than most of us retail traders. So this is how most retail traders, which is us, market takers, think about it. We buy the October 80 straddle at $4.75. So we're buying the October 80 puts and the October 80 calls, and that totals $4.75. So basically, we have something that looks like this. Because when it comes to, well, let's start the call side. Calls have unlimited profit potential, but you can only lose what you pay for it. And puts, same thing, unlimited, well, technically not unlimited, but kind of unlimited profit potential, but you can only lose what you pay for it. So the most you can ever lose on a straddle is what you paid for both the call and the put. But if the stock goes up a lot, you can make more on the call than what you paid for both the call and the put. And if the stock goes down enough, you can make more on the put than what you paid for both the call and the put. And so that's what we do as retail traders or market takers. We're always trying to, when we put on a straddle, we're looking for a really volatile move. And you start out kind of delta neutral as well. Maybe you didn't think about the fact that you can trade delta neutral as a market taker, but you can, because you buy a positive delta call and a positive delta put. They cancel each other out and you're delta neutral. So wait, how do you make money when the stock moves? Well, it's gamma. As the stock moves, the delta changes. When you buy options, it always changes in your favor. The higher the stock goes, the more positive my delta goes, and the more I make, the more the stock goes up. When the stock goes down, my delta gets more negative. And when the stock's going down, I have negative delta. I'm making money. And the further down the stock goes, the more negative my delta gets and the more I make. Now, that's great when the stock moves, but when it doesn't move, that's where I run into trouble. How? Because when I own options, I have what is called negative theta. I pay 3 cents a day. And, that starts adding up. If I paid 475, maybe this is a month-long straddle. If I paid 475, 10 days later, I lost 30 cents. But it actually starts getting bigger as time passes. So I probably lost more like 35, 40, 50 cents. And that next week, I'm going to lose 50, 60, 70 cents. The next week, I'm going to lose $1, $1.50. So I need movement or else I suffer time decay. I also have positive vega. So if implied volatility, which in this example is 29, and I'm just making that number up. If you didn't see that before, don't worry. Implied volatility goes up, I make. If it goes down, I lose. So all the things I need to look at as a market maker are all my Greeks, the volatility, and what is called synthetic straddle. So let's go through each of those. Now, this is a recap. I want all of you to attend all of my Firstrade presentations. And if there are some you missed, go back and look at the archives. I'm trying to cover the entire gamut for you. So this is review. Delta measures the change in option value with changing underlying stock price. Gamma measures the change in delta with the changing stock price. Theta measures the change in option value as time passes. And vega measures the change in option value as implied volatility changes. Now, when I say implied volatility, that's in contrast to realized volatility. Realized volatility is what you think about when you hear the word volatility. It's how much the stock has moved around lately. Technically, it's the annualized standard deviation of closing prices over the past month or so. We can also call this historical volatility, statistical volatility, stock volatility. But implied volatility, what I was talking about, that is how cheap or expensive the options are. It's the measure of supply and demand for that stock. Well, specifically, supply and demand for the options on that stock. The volatility figure that when entered into an option pricing model yields a theoretical value reflecting current market prices. We think of that as the future volatility implied by option prices. But here's the thing. So a straddle is a call plus a put, right? Well, there's something called synthetics. And here, I actually want to line this up just a little bit better to make it a little easier to see here. There we go. Wasn't wrong, but now it's prettier. A straddle is when I buy a call and I buy a put and they have the same strike. But there are these things called synthetics. And one synthetic is if I buy a call and I short 100 shares of stock, that is the same thing as buying a put from a synthetic standpoint. I will make or lose the same amount of money. I have the same risk profile, same risk reward, same chances of success. So that translates to a synthetic straddle where I could buy a call and also buy a call and short 100 shares of stock, which means I can create a position that acts like a straddle with only calls and not puts if I short stock. And this is all covered in my book, Trading Option Greeks. I think some of you have read that. It's on Amazon. So look, if I am going to, and let me just organize this just a smidge here too. Find it a little better if I keep it lined up so it's very easy for you to see. Or, hold on. Okay, that's much better. So if I buy 10 of the October 60 calls and 10 of the October 60 puts. Well, that's the same thing as buying 10 of the October 60 calls, but then buying the synthetic version of the puts. So buying the October 60 calls again and shorting 1,000 shares, right? Because for every one option, for every one call I buy, I'd have to short 100 shares, right? I'm not doing this delta neutral. I'm doing it 1-to-1. Each option represents the rights on 100 shares. So that's the same as buying 20 of the October 60 calls and shorting 1,000 shares. Now, this is a delta neutral market maker strategy. My immediate delta is 0, but I have gamma, which can make my delta work in my favor. But then the flip side of that is theta, that always works against me here. And then I also have implied volatility risk with the gamma. So what market makers will do is they will gamma scalp any position, whether it's a regular straddle or a synthetic straddle. So what I do is I buy or sell stock to neutralize my delta once gamma leads to a delta. So this is a very option-centric type trade, right? This is very professional trading. You need a lot of capital. You need to be really good because you must adjust often. You need to hedge all the time. So say I buy 20 of the October 60, and we'll just say 50 delta calls. So that's long 1,000 shares. And I sell short 1,000 shares at, oops, this should be 40 or 60 rather. And I sell short 1,000 shares at 60. Well, my position is flat delta. So my delta is 0, but because I own options, I have positive gamma. And because I own options, I have negative theta, losing money as time passing. And because I own options, I have positive vega, make money as implied volatility goes up, lose as it goes down. And again, if all this is brand new to you and you're like, holy cow, my head's going to explode here, go back on Firstrade's website, find the class that I did on the Greeks. So this is like a very oversimplified example of how a market maker might trade these, but I think it's important to learn here. Let's say a market maker puts on that trade we just talked about. The stock rallies from 60 to 61. Well, that 2.8 delta makes the synthetic straddle position long 280 shares. So for the market maker to hedge, the market maker would sell short another 280 shares. Now, let's say later that day, the stock just goes back down to 60. Okay, I know it's a very oversimplified example, but you know, it works in real life too. So if it goes back down to 60, then my gamma would get me short the equivalence of 280 shares, which I'd have to buy to hedge, and I would buy 280 shares. So that day, I sold 280 shares at 61, bought 280 shares at 60. So I basically made $1 on 280 shares. That's $280. My theta that day was 65. So 280 minus 65 is 215. Still have the straddle on. Next day, let's say the stock drifts down by a little before lunch to 59.60. Well, that gets me short 1.12 delta, so that's the equivalent of 121 shares. So I buy 112 shares. Then it magically drifts right back up to 60. Holy cow, it's like a magnet, right? Well, that gets me long the equivalence of 112 deltas, so I have to sell. Oops. So I have to sell 112 shares. So basically I have something that looks like this. Bought 112 shares at 59.60, sold 112 at 60. So I made 40 cents on 112 shares. That's $45 minus my theta that day of 65. Ended up losing 20 bucks on this day. The stock didn't move enough. Then what if implied volatility falls 2 points? Well, I'm long 115 Vegas. 2 times 115 means I lose 230 bucks. So I'm losing 230 bucks and losing 15 bucks. That's 245 bucks that I'm losing. So that's how market makers think about straddles. Us as market takers, all we care about is, does it go down enough to go through my break even and cover what I paid for both the call and the put? Or does it go up enough to move through my break even to cover what I paid for the call and the put? Very different ways of thinking about it, right? Let's talk about time spreads, also called calendar spreads or horizontal spreads. That's when I buy one option and sell another option that's the same type, so both calls or both puts. They both have the same strike, but they have a different expiration. So what we typically trade as market takers, retail traders, is long time spreads where we're buying the longer term one and selling the shorter term one. Aslam says this seems to be a lot of calculations and monitoring for the market maker. Do they do it themselves or software monitors it and prompts them? A really good question, Aslam. So when I was on the trading floor, standing in the pits, wearing the silly colored jacket, yelling and shouting all day, I would literally do it myself. I would put in an order to sell if, this one stock that I have a straddle on goes up by $1 and sell more if it goes up by $2, sell more if it goes up by $3, and buy some if it goes down $1, buy more if it goes down $2, buy more if it goes down $3. I would do it manually. These days, a lot of trading is automated because, I would make markets in anywhere between 7 and 20 stocks, options. But these days, a lot of market makers are making markets in 100 or 200 different stocks. So it becomes impossible to do manually. Really good question. So when I buy a time spread, I get a risk profile that looks kind of like this. If it goes down and both calls are super out of the money and worthless, I can lose whatever I paid for the time spread. If it goes up so much that both are so deep in the money that they're 100 delta and there's no time spread left, then I also lose what I pay for the spread. Best place for it to be is right at the shared strike price, because then the short option expires and I get to keep everything there. And the long call is worth as much as it can be without the short option being in the money. So basically, if it goes down too much or up too much, I lose. It's almost like the opposite of a straddle. And one can make a case for saying that it's a hedged synthetic straddle, but I don't want to get too crazy here. So let's say you look at a time spread, whatever this one is. If I put it on when it's pretty close to the money, it's usually pretty delta neutral. Could have a slightly positive delta or a negative delta. And if we go back to this, like below the strike, I have a positive delta. How do I know that? Because if it goes up, I make money. If it goes down, I lose money. That's positive delta. If it's above the strike, I have negative delta. How do I know that? Because if it goes down, I make money. If it goes up, I lose money. That is negative delta. So that could be positive or negative. Gamma is always negative. And again, I encourage you to go back to the course I did on the Greeks to understand this, but shorter term options have more negative or have more gamma than longer term options. And since I'm shorting the short term option, I end up getting negative gamma because the short gamma is bigger than the long gamma. Now that's the opposite with theta. Shorter term options that are near the money have a bigger theta. And those are the ones I'm selling. When I sell an option, I get positive theta. So I get this big positive theta and a small negative theta. So it ends up net positive. And then the vega is net positive. Now, it's net positive, but I don't really think about it like that. I think about it a little differently, which I'll share in a second. So an example here might be I sell these on the market maker's bid, market maker's buying them. And I buy these, market maker selling these. And that's how I set up time spread. And then as long as it doesn't go up too much or down too much, I make money. Now, what I really want to do, and not everybody has access to this information. If you do, I encourage you to start looking at it and eventually start using it. But there's something called term structure of volatility. And that means the volatilities of options on the same stock might be different from one another. And sometimes the volatilities of the different strikes are different. But with time spreads, we're looking at the volatilities of the same strikes, but different expirations being different. That's called term structure of volatility. Okay. And basically what we want to do is we want to sell a higher volatility than we're buying. And what that does is it gives us an edge. Now, there's a lot of caveats to that. If we're right before earnings, we're going to see that the implied volatility of the short-term option is going to be much higher than the long-term one. But we have this volatility event that can hurt us with negative gamma, so we probably don't want to do this. If we're trading just a regular time spread, which we're really trying to make money on theta without it moving too much, right? So we're looking for low volatility. Really, again, just the opposite of straddles. We like to sell a higher volatility option than the one we're buying. Now, give me a yes if you would like to hear the biggest and best secret strategy that I know from the trading floor. Go ahead and hit that questions box, Q&A box, and give me a big old yes if you would like to hear the biggest and best secret strategy from the trading floor. Justin says yes. Maria says yes. Robert says yes. Oslam says yes, all caps. Lewis says yes. William says, for sure, yes, exclamation. Sherry says yes. Ed says yes. Marie says yes. Thomas says yes, all caps. Benjamin says yes. Okay. You guys talked me into it. Here is the biggest and best secret strategy from the trading floor. The secret, put in the effort. And you know what? You're doing that. You're here. So many of you show up every Tuesday at noon Eastern time or 11 Central time, 9 Pacific time. So many of you show up week after week for my sessions. You're putting in the effort to learn, because the more you learn, the more you earn. For me, when I was trading professionally, I had to stand in the pits all day long. At the end of the day, my back hurt, my feet hurt, my head hurt. It was sometimes just physically exhausting, but you know what? I did it because I wanted to win at this game. I'm not going to say, hey, I wanted to make more money. I figured making money is like a byproduct. I was passionate about it. I love it. I loved it then. I love it now. And I think a lot of you do too. So putting in the effort can be really, really easy. Now, I know some of you, maybe sometimes it can feel stressful to try and fit in all the time to, get all the education that you need. And that's okay. You can reduce a lot of that stress by just figuring out how to fit trading and trading education into your lifestyle. You don't have to, you eat the elephant one bite at a time, as they say. You're working a full-time job, maybe watch the recordings. I prefer if you show up live so you can ask questions, and I like to see all of you live every week. I don't get to see who watches the recordings. So fit trading into your lifestyle. Watch 1 or 2 videos like this a week. Go to markettaker.com, click join free. I have started making a lot of shorter videos because it's just easier for a lot of people to watch instead of spending an hour at a time. You know, you might watch this 7-minute video today and this 4-minute video today and watch some more tomorrow. So fit it into your lifestyle, plan times of the day when you're going to put trades on, monitor trades, take them off, and trading can be a super, super rewarding thing. All right, that's all I got. Hope that helped, folks. Have a great, great rest of your day. And I will see you next week when we talk about maximizing profits from trending stocks with options. I'll see you then. Trade smart.